Let's connect with Pankaj Tibrewal as well, who's joining in from Kotak Mutual Fund. Pankaj, hi there. Good morning. Let's talk about the broader markets then. You believe that, after seeing a long period of underperformance, that now potential lies within the broader markets. Does one need to, look at a stock-specific bottom-up approach, or, are you going with sectors here?
Absolutely. I mean, if you look at, a lot of people and market are assuming that post-COVID probably we'll see a start of a new bear market in India. But our thought is that if you look at from a January 2018 to 23rd to March 2020, the broader markets have been in extreme pain. And whatever rally we saw in the previous 2 years was led by very handful of stocks in the frontline indices. And we have seen that mid-cap and small-cap indices underperforming the Nifty by a very wide margin. And this has been one of the longest and the deepest, drawdown, especially for mid and small caps. And if you look at the price damage from January 18 till 23rd March, where we made the bottom 2020, about 79 to 80% of the top 1500 stocks have already corrected by more than 50%. So yes, after a very sharp pullback from the March lows, where Nifty and mid-cap indices both have rallied by about 35-36%, we may see some pullback in the near term. But our thought is that over the next 2 to 3 years, it will be a bottom-up stock pickers market. And we believe that the portfolio which are rightly positioned in right stocks and sectors will be rewarded. And there's a reasonable amount of probability that the broader market may see outperforming Nifty indices in the medium term.
Okay, that's the view coming in. Let's touch upon sectors that you're finding opportunity. There's the specialty chemical space, and we have seen a lot of interest in this sector. Number of outperformers as well. How would you go about picking out businesses within specialty chemicals? Would you like to, share with us some of the stocks or names as well that you find interest with within the space?
So yes, we were quite early on this, theme a couple of years back, where we saw that a large part of supply chain of global agrochemical majors had started to move from China to India, and there were a few handful companies which were, seizing this opportunity. Also, if you look at India, still after last 2-3 years being very good, we are just 4 to 5% of the global specialty chemicals market in terms of market share. And whenever we are interacting with most of the large global companies as well as domestic companies in specialty chemicals, the demand outlook for the next couple of years seems to be extremely strong. Just to rewind back, there are a lot of critics asking whether the Make in India theme will come back, whether we can make it a success. My point is that if you look at over the last 2-3 decades, the corporate boardroom discussions were always on efficiency of supply chain, and every corporate wanted to move just in time. Now the discussion has moved from just in time to just in case. Just in case there's another second wave of round of COVID in China, just in case there's a geopolitical tension out of US and China. How resilient is my supply chain? And hence the resiliency is making the corporate think about a second source of supply chain. And probably in specialty chemical, India fares quite well. So I think the growth momentum in our view, probably this year and in the next 2-3 years will be quite good for a lot of companies in this sector. We should look at more from a CRAMS perspective rather than the commodity chemical companies, because commodity chemical companies will have a volatile end product prices, which is very difficult to predict. So our preference will lie on companies which probably does a lot of manufacturing on a take on pay basis for large global agro majors or pharma majors. And I believe that yes, there's a lot of demand momentum, and there's the outlook seems to be very strong. But I would just like to put a caveat out here that after a very sharp run up in this sector over the last couple of years, the valuations are no longer cheap. So one needs to just also look at from a valuation perspective.
What about the mid caps, Pankaj? You're looking at broader markets outperforming. Which are the pockets in particular that you're eyeing?
Very good question. I think always the myth has been that in a downturn, mid caps and small caps face the brunt. But I think it will be too generalized, making this statement. If you look at even in this environment, there are many sectors which are represented by mid and small caps, and they are the leaders in those sectors, which are doing fairly well. We believe that the silver lining, even in this downturn in the economy, has been rural, and our ground checks are suggesting that whichever company is connected with rural demand is seeing very strong growth momentum, whether it be agrochemicals, fertilizers, also on the tractor side, two-wheeler side, all are seeing very strong demand momentum. And I think this is likely to continue because we may have a very good Kharif season as well. And the sowing already has been very high. The second we discussed on specialty chemicals. This sector is largely represented by mid and small caps. The earning resilience seems to be very strong even in this downturn. The third sector, I think, where a lot of leaders and good cash flows and balance sheet companies are there, is available in cement, home building products like tiles, plywood. You are seeing companies in IT and some mid-sized companies in pharma. So I think the bottom-up stock picking approach will be rewarded in our view in the mid and small cap space. And the way we have positioned our portfolio is to not focus on the next 1 or 2 quarters, but focus on companies probably which will come out much stronger post this downturn. And the earnings and long-term sustainable earnings power of these companies have not been disrupted. Actually, the long-term value of these companies have actually increased. So our focus will be to focus on those companies which can gain market share even in this downturn.
Okay, fair enough. How critical is it also going to be to see that, to see a more broad-based recovery coming in from a market standpoint, given where we're trading right now on the back of liquidity? Anything that you're anticipating in terms of further stimulus? Where do you feel it's most needed? Which are the pockets in particular that are really going to struggle going forward?
So I think clearly we believe that the leverage companies would have a difficult time because it's not going to be a straight line recovery, and there will be volatility along the way, and companies which have high debt and have issues on corporate governance probably will face the brunt. Also, in many sectors, we are seeing that the tail in that sector is having difficulty accessing the credit or the bank loan market. And hence, the funding is becoming an issue and the market share is shifting to the top 3-4 guys in that sector. And I think that trend which started post GST is accelerating now. And we believe that the leaders will probably get much higher multiple in times to come. Also, from a broader market recovery perspective, I think on an aggregate basis, we believe that the next couple of quarters will be difficult for corporate India. But when we look at a lot of companies and sectors, our belief is post this pandemic and whenever the dust settles down, corporate India will come out with a margin and a cost structure which will be far more efficient. I think every company we are speaking to, they are taking measures to cut costs probably which they have not done in the last decade or so, and probably making their cost structure more efficient. So our belief is that once this dust settles down, we would be surprised by corporate India margin profile. And a lot of leverage also from a bottom line perspective goes into margin in mid and small cap companies. So my sense is that whenever revenue growth comes in, the cost structure will not rise to that extent. And hence you will see margin expansion post the pandemic in many companies in the broader market space.
All right, fair enough. You've talked a little bit about cement, specialty chemicals. Where else are you looking right now, Pankaj? What else is looking attractive from a sector standpoint?
So I think, I think the real economy facing sectors probably are looking much more attractive right now. And also, we believe that this sector, which is cement, capital goods, engineering, they all have gone through a very subdued kind of momentum through the last 5-7 years, and the demand has been very anemic. And we believe that very handful of players are now left. So from a supply side, you won't see the same competitive and the price disruption which we saw in the last decade. And once economy starts coming back and you see some capex momentum coming back, led by global corporations setting up shop in India, I think you will see real economy facing stocks doing much better, whether it comes from pipe industry, whether it comes from light engineering, capital goods, cement. I think all sectors hold promise for the next few years from a medium-term perspective.
Okay, Pankaj, we'll let you go on that note. Great to have you on the show.